So with that, now knowing who shouldn't invest, then the question is, okay, then who should invest? And my answer is that within certain limits, everyone else, but not for the reasons that everyone else would tell you. Not because your poker buddy is telling you how much money he's making every day and it's giving you a horrible case of FOMO, but because it is actually the completely and totally rational thing to do. This is our roadmap to sane crypto investing. You can find it on my website if you want to spend some more time over it at sanecrypto.com/roadmap. So it's pretty easy to remember. And let's see if my cursor is going to work here. Great. So just you can see here that we have the risk return ratio going from bottom to top of our pyramid, and that right here, this phase that I have us in is an investable bubble. And let me explain that for a second. I'm not going to go through all of this. You can look at the rest of it on the website if you want. But this bubble, as all bubbles, are characterized by irrational exuberance, a phrase made famous by Alan Greenspan, our Fed chairman, during the internet bubble. It is people with no experience piling in, thinking that they're geniuses, a lot of clouded judgment, because over here, the predominant emotion in a bubble is greed, okay, FOMO. And the way that the key to success in a market like this is, as I've already alluded to, discipline. It's to protect your profits with a rigid plan, that you don't deviate from, that you make as autopilot as you possibly can, so that your greed can't sabotage you. Now, but this is actually the point that I want to make right here. Notice that here, when we're talking about the risk-reward profile of this period, it's something called Pascal's wager, okay? It changes up here, but for here, as long as this list, we are in Pascal's wager. Now, for those of you who are unfamiliar with Pascal's wager, I will just read you a quick description from Wikipedia. Dang it again, I meant to put this on a slide and I forgot. So hang on one second. Note to self, Kim. Okay. Pascal's wager is an argument in philosophy presented by the 17th century French philosopher, mathematician, and physicist Blaise Pascal. It posits that humans bet with their lives that God either exists or does not. Pascal argues that a rational person should live as though God exists and seek to believe in God. If God doesn't actually exist, such a person will have only a finite loss, some pleasures, luxury, etc., whereas they stand to receive infinite gains, as represented by eternity in heaven, and avoid infinite losses, meaning eternity in hell. Still reading. Historically, Pascal's wager was groundbreaking because it charted new territory in probability theory, marked the first formal use of decision theory, and anticipated future philosophies such as existentialism, pragmatism, and volunteerism. Okay, so to sum it up, the nature of Pascal's wager, as he laid it out, is if you gain all. If you lose nothing. Now, in crypto assets, it isn't exactly true that you will lose nothing, but for the moment, the upside downside skew is so lopsided because of the chart that I showed you previously, right? That one. It's probably the closest thing we will ever see to Pascal's wager. normal market rates of return, like which is about 8% in the stock market, which is about the highest market that we have, takes anywhere from 8 to 10 years to double your money. As I said previously, 1 year ago today, Bitcoin was 800 and something, 840 something, right? As of today, Bitcoin is $10,132.30. Even discounting for the run up to 20K and then the subsequent pullback to 10K, that is still a 1,041% return, which of course doesn't mean that it's going to do it again this year or ever again. It could go to zero tomorrow, not, which is why it's similar to Pascal's wager. If I put $50,000 of a $3 million portfolio into, including a retirement portfolio, right, into crypto assets. If I lose it, yeah, it makes me sad. I'm not going to be happy about it, but it's not life-changing. If, on the other hand, that $50,000 had gone up to $682,000, which is what $50,000 invested a year ago today would be worth, yeah, that is meaningful. Okay? It's that upside downside skew that makes investing in crypto assets, if you have the risk capital to do it, okay, which is this right here, okay, risk capital, that's what makes it so compelling. So for now, if you have an investment portfolio, it makes, to me, total sense to peel off 2%. Which is, by the way, the answer to the next question about how much you should invest, and take Pascal's wager. The other reason you should invest is it actually decreases risk in your portfolio, assuming you have a portfolio. So at this point, you probably think like I'm smoking crypto crack, but I'm not, and it's true. Modern portfolio theory, by the way, this is called the Callan periodic table of returns. Actually, this is an alternative version of the Callan table. But anyway, modern portfolio theory, which is where the idea of diversification came from, first suggested in 1952, and for which Harry Markowitz finally won a Nobel Prize in 1990, took him a little while, says that, reading again, it is not enough to look at the expected risk and return of one particular stock or even one particular asset class. By investing in multiple non-correlated asset classes, an investor can reap the benefits of diversification, particularly a reduction in the riskiness of the portfolio. In other words, this modern portfolio theory, okay, this idea of multiple uncorrelated asset classes being less risky, that is why today you hold a portfolio, as you can see, of stocks and bonds and commodities and real estate, etc. Okay? Crypto assets are a new asset class, albeit a little tiny one, as I said earlier, a little bitty guppy for now. But the thing is, they are negatively correlated, which is really hard to come by. In spite of the fact that supposedly stocks and bonds move in opposite directions, a lot of the time they don't. But these things are, for now at least, totally negatively correlated with any of the other assets being held by the typical investor. And this is why you have hedge funds and family offices all getting into crypto. It's because the smart money knows that you just don't see this kind of an opportunity once in a lifetime. A non-correlated asset with such a lopsided upside downside skew is crazy. So as long as you don't screw up Pascal's wager by betting more than risk capital, which again, I would argue is no more than 2% of your portfolio, then Pascal's logic would tell you that investing in crypto assets is not only rational, it is the only rational choice.